Good afternoon and welcome to today's webinar here at East Capital Group from Stockholm. Today's webinar will focus on the latest developments within emerging markets as well as the outlook for the remainder of the year. As such, I'm delighted to have with me East Capital's partner and Chief Investment Officer, Jacob Grapengiesser, as well as East Capital Group's Senior Advisor, Anders Borg, with me in the studio. Welcome both.
Thank you.
Thanks. Before we kick off, I'd also like to remind our viewers that we have a Q&A function available in the chat on your screen. So in case of any questions, please do feel free to share those with us, and we'll make sure to answer them. Great. So Anders, if we kick off with you for an overview of the macroeconomic landscape, there's been a wide range of important data points released recently. We had, of course, the US inflation numbers for July come in last week, slightly below expectations, and we've seen markets stage a bit of a rally. Do you see this rally as sustainable, or do we need to see a longer trend of falling inflation in order for the Fed to start somewhat easing the pace of their rate hikes and perhaps even start cutting rates next year?
Well, I do think that the big picture is pretty clear. We have most of the advanced countries with inflation close to 8% and unemployment below 4%. And in this environment where inflation is high and unemployment unsustainably low, the central banks will continue to hike rates, and they will have support in their ambition to slow demand by the fact that real wages are being eaten by inflation, particularly so in Europe, where inflation is likely to remain slightly higher than in the US during the autumn. This volatile market environment also means that capex is coming in fairly low. And we're also seeing a synchronized slowdown, not only in the US and Europe, but also in China. So global demand is slowing down. So Q2 reports were good, but I think we should be more worried about Q4 and Q1 and Q2 next year, because the slowdown is going to happen. And that implies that in an environment where companies are struggling with margins, we are going to see a lower EPS growth. And also the Biden tax package takes out a bit of the EPS growth for next year. So yeah, I do think that the market will go kind of more sideways than stage a rally from these levels. If you want to be optimistic, I think there is only really one data point that can be pivotal, and that is if we get 2 or 3 additional good inflation numbers in the US, and if we also see that the US labor market is kind of getting into a more sustainable path, then I think it's more kind of a scenario where you can see solid support for the market. But I think we've gotten a little bit ahead of ourselves when it comes to pricing rate hikes in the US. I mean, I think the probability of rate cuts in 23 is fairly low. And I'm more likely to agree with Fed saying that the rate will be at the end of 23 closer to 4% or something like that.
Right. So inflation will continue to be the topic on everyone's minds. Thank you, Anders. If we move somewhat east then to China and Asia, most analysts now seem to agree that China might fall short of its official growth target of 5.5% for this year. But despite this, emerging markets are expected to grow around 3.6%, according to the IMF, comfortably ahead of developed markets at 2.5%. How would you summarize the sort of prevailing economic sentiment across emerging markets?
Yeah, I think it's very important to take on board the fact that inflation is substantially lower in Asia, not only in China with 2.7, but also in Japan and elsewhere in Southeast Asia. Inflation is slightly higher in India, but they are an emerging market economy, so inflation should be slightly higher. So yeah, let's remember that we have roughly 2 billion people with growth also next year close to 5%. Obviously, China is slowing down. And they've added a lot of political risk with Taiwan and the tech clampdown and the kind of power grab that Xi is doing. So I think the environment where the combination of political risk and COVID is kind of weighing on China is there. But I do think one should recognize that Asia in general is actually in not that bad spot. And I mean, PBOC was actually able to cut the rates a couple of days ago, which is fairly unique in the central bank community.
And if we look then at the downside risks, of course, it has been a very turbulent year. There's still a number of sort of unclear factors which will have a big impact on the development of the market moving forward. What would you say are the sort of most important downside risks to consider?
In the short term, it's pretty obvious that it's gas in Germany. If Putin cuts gas deliveries to zero, Bundesbank says that we can have an 8% drop in GDP in Q1 next year, which is a fairly dramatic assessment. On the positive side, gas over the last 2 weeks have storage gone from 70 to 75%. So if we believe that Germans are willing to obey commands and also do that fairly efficient, then maybe in the later part of September, early October, we could kind of have a relief on that risk. But in the short term, I think Putin can play a lot of role for the market, because if he cuts gas and harms Germany as much as this is costing Russia, then I think that's a really relevant risk. And as a supply chain shock, I think Germany is very difficult for the rest of Europe. I think for the US, my main worry is actually the stagflation risk. If the labor market remains strong the whole autumn, if we see that the economy is fairly resilient and inflation comes down slowly, I don't think we should doubt the Fed, that they will do the rate hikes they've signaled this year, and they are willing to front load, I think, in Q1 if necessary. So stagflation is, to me, more worrying than a recession scenario. US tends to be fairly resilient with softer recessions than in Europe. And I don't see the kind of underlying structural issues in the US. So a soft recession, I think, is kind of, that we can live with, because then the market was right and bond yields are coming down. I'm not that worried about COVID in China. In the short term, it has a big stop-go effect on activity. My worries about China is more the debt deflation. If they are not able to deal with real estate markets, and if we see a sharp drop in construction, let's remember that they are spending in terms of GDP 3 times as much as the US. US is spending 3%, 5% of GDP, and China 15% of GDP on construction. That could have a big impact not only this year, but maybe over a period of 2 or 3 years. So real estate market, but in the short term, I would say that the most important market risk is gas in Europe. And let's hope then that we really don't see a stagflation scenario in the US. And I must say that I would put fairly, not negligible, but fairly low probability of a stagflation scenario in the US.
All right. You were sort of touching upon it there, the fact that China continues to see lower inflation, and therefore the central bank also has the ability to stimulate the economy more than in the West, as we saw a couple of days ago here by the rate cut. How would you compare in general the environment in China, and how supportive can this sort of stimulus be for China, but also for emerging markets?
Well, I think traditionally the macroeconomic policies of China has been very solid. So I don't expect them to go Biden on the economy with excessive spending driving inflation. I don't think PBOC wants to to kind of inflate the bubble in the housing market, so they will be fairly cautious. My take on Chinese policymakers is that they can accept 1 or 2 or even 3 years with growth in the neighborhood 3 to 5%. If that implies that they're growing out of this real estate bubble without the macroeconomic shock. So I think they will be fairly prudent, and I think it's a less risk that they get overexcited and do this Keynesian stuff that Biden really did in 21.
Yeah, makes sense. If we stick to the topic of inflation and central banks, central bankers across the world basically now face a very delicate balancing act when they want to try and tame inflation and cool down the economy, but avoiding a recession. How would you sort of summarize their ability to achieve a soft landing versus a hard landing?
I don't think we should doubt the central bankers. They will fight inflation. They will not allow inflation to be entrenched in going forward. So Powell will not go into the history of an Arthur Burns. He wants to be a Greenspan Volcker that really anchors long-term inflation expectations. And the market are now really confident. If you look at the pricing in the market, the market is really saying that 3.5% is enough to secure 2% inflation in the medium term. A little bit premature from my side to make that call. But I do think that Fed is very credible. There will be no repeat of the 70s.
Thank you, Anders. Always interesting to hear your thoughts. If we then move on to you, Jacob, who is managing our global emerging markets portfolio, how would you say that the year has been so far for emerging markets?
Well, it's been a rather difficult year, I must say. We wrote an outlook in December last year, and we said it's going to be an alpha year or a headache for active managers, and I guess it's been more of a headache, to be fairly blunt. But if we look on our emerging markets fund, it's down in euro terms 5% year to date. The index is down 8%, so we're slightly better than the index. But I probably think that 5% is not that bad. You know, I mean, if you would have asked him, one probably would say, oh, maybe it's down 10, 15, even 20%, right? I think one explanation is that emerging markets, they behave in different ways. So now Latin America is very strong. China is a bit weak for the past month because you have more COVID cases. And previously you had China being strong. And hence, you know, the overall volatility of the kind of combined asset classes is actually not that high as you might think. You know, some countries are exporting commodities, some are importing commodities. And as Anders was kind of pointing out, I mean, inflation is not the problem in Asia. You know, we look at, I think, at our home markets, Europe, maybe US, and we have large inflation problems. 2.7% in China, it's not really an issue. You know, I really would say. So I think overall emerging markets, as they stand today, look quite okay. I mean, the index P is around 10. For our fund, it's around 8. But our fund has an expected EPS growth of 51% this year. Admittedly, there are some companies kind of standing out, and even if we would sort of take those companies out, we would be looking at a 30% EPS growth for this year for our fund, and 25% next year. So, you know, when in doubt, at least we at this capital, we look at just, you know, valuations. And if you look, I think at this P of 8, 50% EPS growth, yes, some uncertainty going forward, but probably not that much of uncertainty. I think this is sort of rock bottom valuation levels, and I don't think that the uncertainty is that high.
Great. So certain challenges to consider, but risks largely priced in at these levels. Great to see the outperformance that you mentioned there relative to the index. If you just elaborate a bit on how you and your team are looking to navigate these challenging markets that we've seen.
Yeah, so I think the sort of intuitive reaction is that you do nothing. Maybe if you ask some people what to do in the private portfolios, they say, oh, it's a bit volatile, I just sit back and I don't do anything. I think that's the sort of logical intuitive approach. However, I actually don't think it's the right approach. I think you need to turn up the turnover in the fund when you have this volatility. Of course, it's very difficult to time things, and I don't think you'll ever get the perfect market timing. We have themes like e-commerce in our portfolio. Obviously, everything related to e-commerce is massively down. But we were looking at some companies in Brazil, and you know, from the peak, a company called Sequoia, which is just a derivative of e-commerce, is logistics. So that company was down 85%. We said, okay, is the company making money? Yes, actually they are. Are they free cash flow positive? Yes, they are. They're growing at 30% per year. They're trading at 6 times EBITDA and 4 times next year. Probably it's a buy. Will it go down more? Maybe. We were a bit lucky. Now this company is up 70% in a month. But it is still only 4.7 times EBITDA for next year. So, it clearly can continue, right? So I think this is sort of what you need to force yourself. You need to just force yourself and try to catch those kind of falling knives, because that's where you really make the difference. We added 5 percentage points in alpha in 3 months in our fund. Actually, we had a very rough start of the year, but we managed to climb back and climb to like a number 1 position over 3 years versus our peers because of active changes in the portfolio.
So active stock picking remains key during these turbulent markets when a lot of companies have fallen in value. You mentioned e-commerce as one example there of a sector that we've been looking closely at. Are there any other sectors or companies you would like to highlight as particularly attractive in today's market?
Yeah, right. So just to make it clear, right? So late last year and early this year, we also cut a lot of positions. So we completely sold out, not of everything in e-commerce, but I think of 80% of the positions we had. Not necessarily at the peak, maybe sometimes a bit past the peak, but still, if you can get those like very big picture moves right, you can save yourself a lot of alpha or gain if you buy at the bottom, right? I think there are different themes. What I mentioned now maybe is an intuitive theme, but we're also looking at things like Saudi banks. So the US is hiking interest rates, we all know that. One of the largest beneficiaries that you might not know is the fact that Saudi banks are just making much larger net interest margin. So the economy is doing well. It's an oil-dependent economy. There's no risk of non-performing loans, but basically the whole rate increase goes to the bottom line because the currency in Saudi and most of the Middle East is pegged to the US dollar. So basically they import the interest rates policy of the US. So this year we're looking at 60% EPS growth, for example. I think a final theme that we really like, and is probably the biggest theme in our portfolio, is renewables. That theme is not going away, right? We were looking at polysilicon, and the price of polysilicon 3 months ago was 260. We thought, well, maybe it will stay at these levels. We put that into the model. We realized companies are very, very cheap. However, since then, actually that price is up 20%. So if we plug in spot valuations, one of our key holdings is below P1, but no one will believe me if I say it's below P1 for next year. So we don't plug in spot, even though spot can also go higher because demand for solar panels is probably not going to decrease. If we plug in something that is 20% below spot, we are looking at P 1.1. And it's just sort of forgotten. It's high risk, it's China, people don't really like it. But if you take a 3-year view on such a stock, will it be up? I mean, I'm pretty sure it will be up, right? The question is really how much.
Thanks, Jacob. And it's quite incredible to hear those valuations. I mean, it's pretty much unheard of in a market like Sweden, I'd say. Just to take one question here from our viewers, I'll direct that to you, Anders. It's regarding, there's a number of upcoming elections which will be interesting to follow. What would you say can be the likely market implications of these elections, not least in Italy?
Well, I do think that the election in 25th of September will be crucial. You're getting a right-wing coalition if you look at the polls today. The main market risk, if they start to kind of question the conditionality that is in the transmission protection instrument that ECB has launched, that would really create worries and widen the spread. If that happens as a kind of a scenario where Germany is going into a recession, I think there is a big risk that we could see something like at least a mild repetition of the euro crisis. At the end of the day, I think ECB will throw out the conditionality, but that is a process and it will take some period of spread widening before you're there. And I also think if you take the Russian perspective, that if Putin has one ambition, it is to break up this strong NATO support for the operation, for what they are doing in Ukraine to support the fight against the Russian invasion. Italy is a starting point. Next year you have the election in Spain and the election in Greece. So I think from that perspective, in a bad scenario, the political risk in Europe is probably higher than in the US. But I mean, if you could obviously see this also kind of panning out with the lower risk if we don't have the German gas crisis, I think Europe would be kind of decent.
And with the Chinese Congress coming up as well, is there anything to be extra cautious of there, or?
Well, I think we've been very mindful of the political risks in China. We've tried to stay out of sectors that has been exposed to different political volatility. We don't foresee China to go back to the pre-C environment where it's long-term growth and stability that is the notion. So I think we are going to see China playing the nationalist card on Taiwan. Maybe they don't want to provoke a war. That's probably too costly, but it will be there. We have a Republican majority coming back in November, and the probability of Trump re-elected is then increasing. That could also imply some volatility when it comes to the trade war. So yeah, there are political issues with China, and I think Jacob and the team has been very efficient in navigating how to get exposure to the growth and to the secular growth trends without being overexposed to the political risks.
I agree. No lack of events to keep an eye on here for the fall, that's for sure. Thank you both. Before we finish, are there any final comments or remarks you would like to share with our viewers?
Well, I think the most important perspective is to be long-term. Equity is a good bet when you have a longer horizon. Emerging markets are growing. If you take a 3 or 4 year perspective, we're probably going to see at least 3 billion people growing close to 5%. All of these underlying technological trends like digitalization, sustainability, growing prosperity and middle class, all of these are intact. We haven't really changed our worldview. There is an issue with valuations and interest rates and slowdown, but if you raise the perspective, it's pretty clear that the emerging market in Asia is kind of growing in the medium term.
Jacob, anything you'd like to add?
Yeah, I think when in doubt, just look at the numbers, really, you can never really tell. I think the markets are now starting to price a bit of a recession and hence interest rates coming down. If that's the case, clearly markets will continue up. However, downside risks are also quite large. So, just look at this P8, 30 or 50% EPS growth. I mean, I think that's probably still an attractive case to be made. But risks are there, and admittedly, the spectrum of risks is much larger, from China, Taiwan to stagflation in the US. So it's going to be a tricky landscape to maneuver, and I think we need to be honest about that as well.
All right. So with those final words, I'd like to thank all of you for dialing in today. I hope you've enjoyed listening in to our expert insights here from Anders Borg and Jacob Grapengiesser. In case you have any further questions, please do feel free to contact either myself or the investor relations team at ir@eastcapital.com. That's all for us from Stockholm. See you next time.
Thank you very much.
Thank you.